When you work a standard 9 to 5, your employer pays half of your payroll taxes for you. But the moment you strike out on your own and form an LLC, that shared responsibility disappears. You are now responsible for the entire bill. This is the reality of the self-employment tax. While an employee sees 7.65% leave their check, an LLC owner pays the full 15.3%. That 15.3% covers two pillars: 12.4% for Social Security and 2.9% for Medicare. To put that in perspective, a freelancer earning $70,000 in net business profit will owe approximately $9,890 in self-employment tax alone. This nearly $10,000 bill is due before you even begin calculating your standard federal income tax. For most entrepreneurs, this is the single largest tax they will pay. Mastering the mechanics of how this is calculated and how it can be legally reduced is the most effective way to protect your business's actual take-home revenue. The first thing to understand is that the IRS does not tax your gross revenue. They only apply the self-employment tax to your net profit, the money left over after your business expenses are paid. After subtracting your expenses, the IRS provides a small adjustment. You multiply your net profit by 92.35% to find your actual SE tax base. The 15.3% rate is then applied to that adjusted number, which determines the final amount of tax you owe for the year. Once that tax is calculated, the IRS gives you one more automatic saving. You are allowed to take 50% of the self-employment tax you just calculated and deduct it from your personal gross income. This is known as an above-the-line deduction. It lowers your taxable income for your standard federal return, meaning you pay less income tax simply by accurately reporting your self-employment tax. The most direct way to reduce what you owe is to lower your net profit. Every legitimate business expense you track, from equipment to professional services, directly reduces the base the IRS uses for that 15.3% calculation. For businesses consistently earning more than $50,000 in annual profit, the S Corp election becomes a viable structural change. This allows you to reclassify your earnings, dividing your income into a reasonable salary and owner distributions. Only the portion you designate as your salary is subject to the 15.3% payroll tax. The remaining amount, the distributions, is exempt from self-employment tax. You only pay standard income tax on that portion. The numbers show the impact. At $100,000 in net profit, a standard LLC owner pays roughly $14,130. Under an S Corp election with a $55,000 salary, that bill drops to $8,415. That is a $5,700 reduction in your annual tax burden. You can also use self-employed retirement accounts, such as a SEP IRA or a solo 401k, to lower your liability. These contributions are fully deductible, meaning they reduce your taxable net income today while building your personal savings for the future. While basic expense tracking is necessary, these structural choices and retirement contributions are the most significant methods available to reduce the total amount you owe the government. To keep this system running, you have to change your financial habits. Because there is no employer to withhold your taxes, the IRS requires you to manage that collection yourself. To avoid underpayment penalties, you must pay your taxes in 4 quarterly installments. These deadlines generally fall in April, June, September, and January. The most effective way to prepare for these payments is to set aside 25 to 30% of every client payment you receive into a separate tax account. This percentage is designed to cover both the 15.3% self-employment tax and your estimated federal income tax, ensuring the cash is ready when the deadline arrives. Following these compliance schedules and tax strategies turns a complex financial obligation into a managed, predictable part of your business operations.